All right, lock in for a second, because what just went down in the metals market is not your standard garden variety pullback. This was the kind of move that rattles nervous holders, sets the futures floor on fire, and quietly signals that the real action is unfolding somewhere most people aren't even watching. It's Tuesday, February 3rd, and the clock reads 9:41 a.m. in New York. Drop a comment right now and tell me what time it is where you're watching from. Quick note before we dive in. I'm actively running a push to shut down copycat channels. If you appreciate how I break these moves apart, hit subscribe and comment John AG so the algorithm knows where the real community lives. Today we've got three major threads to pull. Miss even one of them, and the entire move gets misread. First, the sell-off you just witnessed does not look like a market topping out. It looks like a market shifting gears, and those two things are worlds apart. The underlying structure beneath gold, silver, and the miners still looks early stage, not late cycle, and the way volatility behaved, that's the tell. But it's an easy tell to misinterpret, so I'm going to walk you through exactly why. Second, China just turned the volume way up on its currency ambitions, not the polite background noise version. The "we want a real seat at the reserve table" version. That matters for metals, it matters for energy, and it matters for the dollar. But here's the catch. The most popular explanation floating around right now is way too neat and tidy. I don't buy it in its current form, and I'll explain why. Third, and this is the part most people still don't grasp, a silver-linked product trading in China hit an emergency halt, and the timing lined up perfectly with a global shakeout. That collision tells you something uncomfortable about where price pressure is coming from, where stress is building, and who is actually stuck. And yes, the description includes bonus links, including the premium WhatsApp channel and the channel membership join link. No excuses. If you want the extra material, it's there. All right, take a breath. Let's step into the morning tape like adults and set the tone with one sentence. When a market is truly finished, it doesn't need a complicated story to justify falling, it just drops. What we saw instead was the sell button getting hammered while the underlying narrative refused to budge. That's why you're hearing so much noise. Noise is what happens when price and story don't line up. If you're new here, understand this. Gold and silver do not trade like regular stocks. Stocks are driven by growth narratives. Metals are driven by trust narratives. And trust narratives don't end with tidy chart patterns. They end when people stop caring about protection. We are nowhere close to that point. So when someone says Friday proved it's all over, my question is simple. Over for whom? Over for leveraged tourists? Maybe. Over for the broader macro trend? That's not what the tape is telling us. And if you're watching from outside the United States, drop your country in the comments as well. I read those. They help me understand where this community is feeling pressure first. Currency stress, inflation, supply constraints, all of it. I want to hear from you. Zooming out to the broader picture, long-dated rates barely flinched. The dollar firmed. Stocks leaned red. Volatility ticked higher. Gold got hit hard. Silver thrashed around like it had a personality disorder. And the miners did what miners always do when leverage collides with panic. They overreact. Here's your first retention hook. The price action you're staring at is not the whole story. The real story lives in the spread. When you compare metal prices across regions, you're not looking at one unified market. You're watching a tug of war between physical demand, paper positioning, and local constraints. And lately, one region has been consistently paying more than another. That's not a tax quirk. That's a demand signal. So if you've been asking, why are prices falling if demand is strong? The answer might be that paper markets can bully price in the short term, but they cannot erase real bids forever. The trick is figuring out whether that bid is still alive or whether it's simply out of breath. Now let's tackle the first storyline, the claim that this pullback proves exhaustion. I don't see exhaustion, I see a shakeout. Exhaustion looks like leadership breaking down. It looks like the strongest assets losing their edge. It looks like a blow-off followed by silence. What we got instead was a sharp slap and then signs that the broader momentum picture stayed intact. And that distinction matters, because in real bull phases, volatility isn't always a warning. Sometimes it's fuel. Here's a simple mental test I use. In topping markets, bad news accelerates downside and good news does nothing. In building markets, bad news gets absorbed and good news sparks fast rebounds. That's why reaction matters more than the headline itself. Ask yourself this. Did the market collapse into the close and stay pinned there? Or did it try to break, then hesitate? That hesitation is where the real game is played, because hesitation means buyers are stepping in quietly without ringing a bell. Also pay attention to how dips are treated in related corners of the market. Royalty companies, high-quality producers, streaming models. When those hold up while headlines are screaming doom, it's a sign that smart money isn't panicking. It's choosing carefully. Think about it this way. Early in a new regime, the market discovers there are more buyers underneath than anyone expected. The way it tests that is by yanking price lower. If buyers show up quickly, that down move becomes evidence of strength, not weakness. It's the market stress testing its own foundation. Now, I'm not saying we can't see more downside. We absolutely can. What I am saying is that the character of this move does not resemble historical tops. And if you've been around long enough, real tops don't usually announce themselves by offering clean, buyable dips that get scooped up. Here's the part most people skip: relative performance. When metals are truly rolling over, miners usually lead the decline. They don't just dip, they fall apart and keep falling. When metals are entering a new phase, miners can be volatile and messy, but they tend to retain leadership over time. Recent data on fund flows and positioning shows something interesting. Even after sharp down days, appetite for metals exposure doesn't vanish. It rotates. That's why I'm careful with the word sell-off. Sometimes a sell-off is just a transfer from weak hands to strong hands, from late cycle chasers to patient capital. If that's what's happening, then the drama you're watching is the market clearing space for the next leg. Yes, I know the mainstream narrative right now is that speculators got too crowded. That's the easy story. But easy stories are usually the ones you pay for later. So here's the checklist. 1. Do key breakout levels hold? 2. Does physical demand continue to show more urgency than paper positioning? 3. Do miners regain their footing after the hit? And 4. Does the dollar rally actually stick? Or does it fade like so many safe haven pops do once deficits and issuance realities reassert themselves? Because here's the cliffhanger. The dollar is the quiet antagonist in this whole setup, and the next chapter may already be underway. Now let's move into story number 2. China and the reserve currency conversation. You've probably heard the line that China wants to replace the dollar. That's overly dramatic. That's a headline, not an analysis. A more realistic framing is that China wants its currency to be one of several reserve options in a more fragmented global system. That's not conspiracy. That's basic statecraft during periods of systemic stress. Zoom out. Reserve currencies don't flip overnight. Historically, they fade through erosion of trust, war costs, and balance sheet strain. Sometimes it takes decades, and the transition is rarely clean. It's usually a messy overlap where multiple currencies share the stage while trade patterns shift underneath. That overlapping phase is exactly where metals shine, because metals don't need permission from central banks. They don't require swap lines. They don't rely on treaties. They simply exist as a neutral scoreboard. If you want a practical reason why countries keep buying gold even when it's expensive in their own currency, this is it. Gold is the reserve asset that doesn't carry someone else's policy risk. You can't be frozen out of it the way you can be frozen out of payment systems. In a world discovering that sanctions and financial infrastructure are weapons, neutral reserves become more valuable, not less. And global stress is everywhere. Trade disputes, supply chain reshoring, sanctions, political fragmentation. In a world learning that access matters as much as price, optionality becomes critical. Countries want fewer choke points. They want settlement paths that can't be turned off. So yes, a louder push for currency relevance matters, but here's my skeptical angle. People assume the world will adopt a new reserve just because a large country asks nicely. That's not how this works. Reserve status is earned slowly, through deep capital markets, legal predictability, consistent rules, and the ability to move massive sums without getting trapped. That's why even countries that dislike the dollar still use it, not because they love it, but because it's liquid. So what's China's play? One angle is trade settlement. Price and settle more contracts in your own currency, and you reduce dependence on foreign pipes. Another angle is institution building, making it less risky for outsiders to hold your currency. And another angle is signaling. When leadership says it out loud, it aligns bureaucracies and tells markets this isn't a short-term experiment. Now, you've heard claims that the currency will be implicitly backed by gold. Let's be precise. There's a grounded version of that idea, and there's a fantasy version. The grounded version is that a country can enhance credibility by accumulating reserves, including gold, and by letting gold quietly support confidence. Not a formal gold standard, but a confidence anchor. The fantasy version is that the currency suddenly becomes gold convertible in a way that forces the world to treat it like classical money. That's a massive leap. True convertibility constrains domestic policy, and governments rarely volunteer for that level of discipline. So my view is pragmatic. Gold can function as strategic collateral, a balance sheet stabilizer, and a signaling tool. But that's not the same thing as clean backing, and that distinction matters when you're forecasting impacts on gold and silver. Here's the takeaway. Even without formal backing, competition to offer alternatives pushes reserve diversification, and reserve diversification benefits monetary metals. Because when you diversify away from one currency, you don't just buy another, you buy neutral assets as well. Now we arrive at story 3, the silver shock. This is where things get interesting. A silver-linked product in China hit an emergency trading halt due to runaway premiums and volatility. At the same time, global paper prices took a hit, and margin requirements were tightened at a major futures exchange. That combination is not coincidence. Translation. When margins rise during chaos, leverage players are forced to either post cash or cut positions. That creates mechanical selling. It doesn't mean the fundamental story flipped overnight. It means the plumbing demanded collateral. As for that Chinese product, it's long only. You can't simply short it to keep it aligned. When you can't short something, you can't easily arbitrage away hype. It can trade at strange premiums, attract flows from investors with limited access elsewhere, and exaggerate moves. That's why long-only wrappers on derivatives become pressure cookers. You're stacking a wrapper on a derivative on a spot market and then acting surprised when it behaves like a casino chip. This isn't how you build stability. It's how you build a crowd that can't exit smoothly. There's another layer almost nobody talks about: inventory. Silver isn't stored like gold. Gold is held as wealth. Silver is held as working inventory, and working inventory gets consumed. That means visible stockpiles can look fine until suddenly they're not. Then the scramble begins. First it shows up in premiums, then in delivery delays. Only later does it hit the headline price. In past squeezes, you often see lease tightness and front-end pricing pressure before the big charts wake up. I'm not saying we're in a full squeeze right now. I'm saying the ingredients are the kind that can turn a normal dip into an abnormal snap if one more catalyst lands. So let me ask you, do you think this is primarily about industrial demand or primarily about financial positioning? Drop your answer in the comments, because silver psychology is half the market. Here's the cliffhanger. When that crowd tries to exit, the stress doesn't stay contained, it leaks, and it shows up in regional spreads. If Chinese demand were truly finished, you'd expect premiums to collapse during a global sell-off. Instead, the spread widened while prices fell. That's a loud signal. Either the bid hasn't been satisfied, or the system can't let it be satisfied without breaking something. That's why I keep saying silver isn't just a trade. It's an industrial input, a strategic resource, and a monetary barometer all at once. It sits at the crossroads of manufacturing and money. And when the world fractures into blocks, assets at intersections get contested. Recent updates show silver demand tied to electrification and solar remains structurally strong, even if quarterly numbers bounce around. Silver isn't just coins and jewelry anymore. It's paste, solder, circuitry. The more grids we build, the more we rely on metals that can't be printed. So if China is worried about raw materials, silver matters. If Europe is worried about supply security, silver matters. If the US is rebuilding industrial capacity, silver matters. It's embedded in everything that keeps modern life running. Zooming back to the morning scoreboard without drowning in decimals. Rates roughly steady. Dollar slightly stronger. Stocks softer. Volatility up. Gold sharply lower from the prior close. Silver whipsawing, with futures and spot not perfectly aligned across time zones. And while you're watching headlines, the real game is the basis. Here's a simple way to think about it. Spot is the immediate price in one region. Futures represent later delivery elsewhere. When one region consistently pays more, it signals either stronger immediate demand or delivery constraints. When spreads widen during sell-offs, it often means selling is paper-driven, not demand-driven. But here's the caution. Spreads can also widen due to capital controls, liquidity gaps, or product distortions. So don't treat the spread like gospel. Use it like a thermometer. It tells you something's off, not exactly why. Now, about blaming bad actors. Sure, bad actors exist, but that explanation is lazy. Markets move because incentives shift. Raise margins, incentives change. Trap flow in a long-only product, incentives change. Tighten global risk, incentives change. Liquidity dries up, incentives change. So instead of hunting villains, I focus on mechanics. 1. Leverage got forced out. 2. Regional demand stayed firm. 3. Paper tried to drag physical lower and didn't fully succeed. 4. The broader monetary metals trend remains intact unless key levels break and stay broken. Let's keep the progression intact and touch the additional analysis that actually helps. Lately, more big money commentary is shifting toward the idea that the next metals phase won't be panic-driven, but debasement-driven. That's a huge difference. Panic is fast. Debasement is slow and relentless. Panic spikes. Debasement trends. Why does that matter? Because in debasement phases, dips get treated differently. People stop selling them and start using them. The crowd changes. Here's context you didn't hear elsewhere. The fiscal backdrop. The US is running massive deficits. Financing costs rise with yields. When yields stay high, interest costs become politically painful. Historically, that tension leads to financial repression, keeping nominal yields contained while inflation erodes debt in real terms. That environment has historically favored gold, not because it's mystical, but because it's an alternative when cash quietly loses purchasing power. Silver in that environment behaves like a coiled spring and like a drama queen. It overreacts, gets shoved around, and then rips when conditions line up. So the question becomes, did a door just open, or did someone slam it shut? On supply, silver isn't easy to ramp. Much of it is a byproduct of other mining. You can't just flip a switch and flood the market. That's why supply tightness can persist even when price is pressured. On demand, silver has both emotional investment demand and contractual industrial demand. When industrial demand is strong, it puts a long-term floor under price. Now back to gold, the anchor. Gold took a hit, but look inside the session. Buyers stepped in. Wicks matter. Wicks record rejection. A long wick means price tried lower and got turned back. That doesn't guarantee a bottom, but it tells you the market isn't one-sided. You might be asking, if this is early bull structure, why does it feel so violent? Because early bull markets are messy, smooth comes later. Early phases are built on disbelief. They rise while people argue, dip while people celebrate being right, and punish both sides. Don't confuse volatility with failure. That's not a pep talk. That's pattern recognition. If you want levels, fine, but behavior matters more. Does gold recover quickly after sharp hits? Does silver hold breakout zones on a closing basis? Do miners stop bleeding and resume leadership? Is the dollar move a squeeze or a trend? Dollar strength can be a head fake when driven by short-term positioning rather than fundamentals. And fundamentals still include debt, deficits, and the world's desire to avoid reliance on a single pipe. Macro overlay matters. Political headlines can look deflationary at first glance. Hawks tighten expectations, risk wobbles, leverage unwinds, metals get hit in the crossfire, even if the thesis holds. If China's equity market truly unravels, that changes the tone. Until then, this looks like plumbing stress layered on a structural shift. One more assumption to challenge. China's actions aren't only about monetary prestige, there's also industrial security. Influence pricing and settlement in strategic materials, and you gain supply chain leverage. That's power. Not a grand plot, just defense. To physical holders, I'm not telling you to buy or sell. I'm pointing out why physical ownership behaves differently from paper. Paper trades easily and gets forced out easily. Physical doesn't get margin called. It just sits while people argue. Quick member note. We do offer members-only videos produced by a separate research team that go deeper into positioning and risk. The join link is in the description. Back to silver. It's doing what silver always does, making everyone emotional. Bulls feel betrayed, bears feel emboldened. Then it snaps and embarrasses both. Here's a framework. If regional premiums stay elevated while paper sells, that's supportive over time. If premiums collapse and stay collapsed, demand may be satisfied or throttled. If the halted product reopens and trades wildly again, the crowd is still there. If it reopens calmly, pressure likely exited elsewhere. It's not over. It's evolving. One more thing. Settlements. Markets close at different times. Compare without adjusting and you'll fool yourself. Watch overlapping hours. That's when spreads matter. Gold again because it's the compass. The pullback was sharp, but behavior still looks like accumulation, not abandonment. Public data shows hard asset allocations creeping higher. Not a stampede, a drip, but drips fill buckets. The classic 60-40 world worked when bonds hedge stocks. Inflation breaks that relationship. When both fail together, investors look for a different ballast. Gold comes back into the conversation. This week matters. Labor data, manufacturing surveys, rate expectations, they all move the dollar, which moves metals short term. Expect chop. Chop is part of the process. Who sets silver's price? Not one market. It's set where marginal pressure is highest. Right now, paper pressure is fighting a physical bid constrained by regional realities. That's why the spread matters. It's a stretched rope. Eventually something gives. Be blunt. Derivatives on derivatives are volatility machines, not investment tools for most people. They turn commodities into game tokens. When crowds get trapped, systems seek order. Through halts, margin changes, or pressure shifts, energy matters too. Energy costs affect mining margins and inflation expectations. Weak energy can signal growth fears. Strong energy can signal tight supply. Mixed signals mean no single narrative wins. One last thing. If your plan requires being right today, you don't have a plan, you have a mood. Real plans survive ugly weeks. I always ask, what would change my mind? For me, it's sustained leadership failure, sustained bid collapse, and metals acting like dead weight instead of protection. We're not there yet. Tie it all together. 1. Metals sold off, but structural signals still look early. 2. China is signaling long-term currency ambition, boosting diversification incentives. 3. A China-linked silver halt collided with global margin tightening, exposing paper physical fragility. So, what do? Stay calm. Watch behavior, not headlines. Watch spreads during overlap. Watch leadership. Watch the dollar. And remember, markets punish certainty. If this helped, hit like. Check the description for bonus links, including the premium WhatsApp and membership options. I'll see you tomorrow, and we'll see whether this was just a scare or the launch pad. And to be clear, none of this is financial advice. I'm sharing analysis for education and discussion so you can better evaluate risk, incentives, and structure before making your own decisions with your own capital.